Kim, you mentioned there that the 1031 could be going away with the new administration. Can we talk about some of the new legislation that could affect cost segregation, accelerated depreciation, and other aspects of real estate investing?
Yeah, okay, so I just did a webinar just recently with Ryan McCormick, who's the vice president of the Real Estate Roundtable in Washington, D.C. So I hosted him. We talked about a post-election tax update, as to what we think is going to happen. Everything is still pretty much up in the air, but we have an idea. We have a Biden's tax plan, which is on his website. You can read that. I strongly encourage you to read that so that you can get prepared about what might be coming down the pipeline. But, the first thing he says is he's going to do away with the Tax Cuts and Jobs Act. So whether he does or whether he's capable of doing that, I think remains to be seen. Ultimately it's going to depend on the Senate and who takes control of that in January. But essentially, what we have to remember is that depreciation or cost segregation isn't anything extra. Okay, just because you're getting more depreciation up front doesn't mean that you're getting more. Okay, it's the same amount whether you depreciate it now or over 39 years. And so I always use the analogy that as an investor and as a real estate investor myself, if I won $40,000 on a scratch-it ticket, and they came to me and they said, hey, we'll give you $37,000 right now cash, or we'll pay you $1,000 a year for 40 years. I would take the $37,000 because I know the value of the money now, and most people would, as long as they can invest it. But maybe that person is really bad with money, right? Maybe they don't know how to invest it. They don't know how to make that grow for them. And they know in their mind that they're just going to blow it. They would rather have the $1,000 a year for 40 years. They may take that. That's basically what cost segregation is. It is a tool. You're not going to go build a house with a hammer. You're going to need all kinds of different tools, right? So using cost segregation should be a tool in your tool belt. It should not be the only tool, right? You want to use 1031 exchanges. You want to use bonus depreciation. You want to use strategies of improvements and when to do those improvements to help you build that tax portfolio. So going back to my question about the legislation, it's the same money. Just because you're getting bonus depreciation, you get more now, you are getting less later, right? So let me give you an example. Back to our $1 million analogy with the $350,000. We already know that if you didn't do cost seg, you'd get $36,000 a year, right? So if you did the cost seg, you'd have $650,000 left over. So essentially, what we talked about, you'd get $350,000 in year one with the bonus depreciation, and then you would end up getting $23,000 a year every year after that instead of 36. Okay, so you have this little bit of arbitrage. You're not going to get the 36,000 that you would every single year for 39 years. You get a big bump up with the first year for the 350,000, then you get 23,000 every year after that. So it just reallocates the depreciation. This is why I feel like I don't know that bonus depreciation is going to be going away, because first of all, it's only good through 2026, so it begins to sunset in 2023 when it goes from 100% to 80%, and then 60, 40, and 20, and then it's ultimately gone in 2027. So my thought process is, if I'm the new president-elect and I'm coming in and I'm going to do away with bonus depreciation, I can't claim that I just, regained how much millions of dollars or billions of dollars in tax recovery, because I didn't, because it's the same money. Whether I get it now or later, it's the same money. So it isn't a bonus. And it's also helping the economy continue to grow. And that was the original idea behind it, was to increase the GDP. Keep in mind also that bonus depreciation was enhanced by Obama in 2011. So this is more of a bipartisan tool that anyone in government will use to turn on and turn off when it sees fit for the economy. I don't see bonus depreciation going away. 1031s are probably at risk. And that's because we have bonus depreciation. So I wonder what's going to happen. Are they going to do away with 1031 exchanges? And then as bonus depreciation phases out, are they going to bring 1031s back, or could they? I don't know. That's a little bit of a more of a sticky situation. I think that would be a huge win for Biden, since he does want to kind of get more money from the wealthy. I think he would probably do away with that, because that is a win for them, that they could say, hey, we're going to regain this much in tax dollars by doing away with 1031 exchanges and make everyone pay their capital gains.
So there's talks about 1031 exchange going around. Obviously, it's not just up to Biden. It has to pass Senate, pass House, and everybody has to approve on it. Same thing with going away with bonus depreciation, but you think, for the reasons you mentioned, it's probably not going to go away. Are there any other significant changes that we can expect from 2021?
Your tax rates will go up. I mean, that's the bottom line. They will go up. And if your tax rate doesn't go up, it's very clearly laid out in Biden's plan. And I know that there's a lot of advertisements out there that if you're making less than $400,000 a year, that your taxes will not go up. But ultimately, even if your taxes don't go up, because the taxes are being raised on businesses and people who make money, it is going to be a trickle-down effect. So costs are just going to be higher across the board, regardless. We know that capital gains tax is probably going to be increased. We know that the tax rate is going to go back up to 39.6%, so it's at the highest level. So we can expect that there will be changes. As in any tax rule, there's always changes. But with the new president, I do think that there's going to be tax increases across the board, especially in the real estate. We've been very fortunate to have a real estate president for the last 4 years. And, hopefully everyone has been able to utilize some of those benefits in the taxes. I will tell you, and I think this is important to note, just because we're trying to get the word out, I'm working directly on Capitol Hill to try and get a bill that essentially extends this look-back period. But right now, the way it sits, the 2020 is the last tax year that we are able to go back retroactively to get bonus depreciation that we were due but didn't take it. So let me give you an example. If you bought a building in 2018, if you bought a building in 18 and you put it on a straight line depreciation, right now you can go back and do a cost study on that. It would qualify for bonus depreciation. You can get the bonus depreciation and bring that forward into your 2020 tax year without having to amend your taxes. In 2021, that turns off. You will not be able to go back and get retroactive bonus depreciation. So basically, the reason for that is because we've had this bonus depreciation rule since 2017, the increase. And what the government is saying and the IRS is saying is that you've had 3 years to know about this. And if you didn't go back and get it by now, you must have just decided you didn't want it, and so you didn't make the change. And so what they're saying is you're going to cut that off. And so 2020, this is the last tax year. So if anyone owns property, that was purchased at the end of 17, 18, or 19, that they put it on straight line depreciation and they want to go back and do a cost study and claim their bonus depreciation, this is the last year to do it. Also, interestingly enough, is that we have the CARES Act, which was for 2019 and 2020. And what that says is, let's say, let me give you an example. Let's say I bought 5 buildings in 2018, okay, and I put them all on straight line depreciation. And didn't really know about cost segregation. Then in 2020, I come in and go back and do a cost study on all of those to get my bonus depreciation. And I take this huge loss into 2020, okay? Far more than I need as far as my income goes. All right, so it's in excess. Because of the CARES Act, we are allowed in 2020 to carry back those losses to 5 previous tax years and get refunds on those those taxes that have been paid previously. So you can use cost segregation right now. You're going back to say 2018 or 2019, do the cost seg study, claim the bonus depreciation. You bring that forward to the current tax year using a change of accounting method. Okay, so you don't have to amend the taxes, but it will plop into the 2020 return. And then when you file your 2020 taxes, if you have a net operating loss, you can take those losses and carry those back to the 5 previous tax years. You get huge income, cash flow back in your pocket. But again, this is the last year that you can do it. And you have to file an on-time filing. It's not on an extension for the look back on cost seg. So these are points that we want to try and get those across. There is this urgency to be able to get these things done and get your book square to what was eligible to you at the time, and get that taken care of, and really help you with the cash flow when we can.
Thanks for joining us today. You can find more episodes at therealworkshop.org.